Welcome to the first ever Voice of Galt weekly YouTube update. I hope to sort of fill in the gaps that you do not see when you listen to the show and give you some visuals to go along with it. The information presented is not for investing purposes, nor should be construed as investing advice. Please consult a certified financial professional or C.F.A. before using this information. This is purely for historical observation, and as you can see, the charts are up. The Dow Jones Industrial Average has experienced a death cross just like every other average, and this death cross occurred in July, a little bit later than some of the other markets. However, the rally on Friday doesn't fill the gaps, and I think we're going to see a continued decline, as you can see from this longer term chart of the 2-year daily of the Dow Jones, and I think we're going to see a target somewhere between 8,000 and 8,600. We could be a little bit higher or even a little bit lower. What's going to happen is we're going to start seeing an even greater series of lower highs and lower lows. That is going to trigger a very adverse reaction in our economy and in the markets as a whole. This continues into other markets. The NASDAQ, a much broader index, showing deterioration all the way back in May with the flash crash. We've had nothing but lower highs and lower lows since, except for the one blip up to 2309 on an intraday basis in early August. But since that time, the 50-day moving average has rolled over, as has the 200 flattened and prepared to roll over. The next thing that makes it even worse, the 2-year. The target area I have for that is between 1700 and 1900. Leaning towards the low side of that after the death cross. I think we're going to see a rapid deterioration in the technology markets as people begin to realize there's not going to be a great Christmas. Santa doesn't care. And the technical condition of the broader market, whether you look at the Russell, the NASDAQ, or the NYSE, is very, very poor. The S&P 500 year-to-date reflects that also. I've circled the death cross, but I've also put some other circles around 1173, 1131, 1129, etc. My next target is 1070 is probably going to be the 1070 1090 is probably going to be the top of the rally that we're seeing right now before Labor Day. I think we're going to go well down into the 900 or even the 890 area. When you look at the longer term chart, which is up on your screens now, I think 869 is going to be your pre-election floor, and that was an intraday low back in July of last year. We're going to test that. If we fail, we're opening the door for 740-ish to 750, but in reality, I can't see us making that dramatic a move before the elections. The 3-year chart really brings this to light. The 3-year chart, I've drawn a target area where I shows the window between 869 and 956 that I think the markets can fall into. But from the peak way back in December of 2007, when we had the last daily death crossed to the final low at 666, and then the rally since, we've had another death cross. I honestly am starting to believe more and more in that technical formation, and I think that this is going to break down after the elections and make an all-time low. Probably in the 417 to 420 area on the S&P, but that's a guess right now. More at a later date. Gold, however, has been holding up nicely. Year to date, if you notice, I've drawn two floors, one around 1150, 1160, another one around 1085, 1090. I think that that's going to be your floors. We should see some deterioration in the gold markets because people are going to sell gold and get into the dollar as there's a little bit of a panic about deflation. And that's a natural thing. We're going to do an opposite of the normal seasonality for gold. On the long term, though, when you look at the 3-year chart, lower left to upper right, something that Dougie Cass and even our friends on Bubble Vision have to acknowledge is a bullish move. And as you see, we've come from the high 600s all the way up to 1240-ish or so. I think we're going to continue to see that trend for quite a long time to come. To get a better idea of the deterioration we're seeing in our markets, let's look at the big Mac Daddy of them all. That's right, the king of the Federal Reserve, Goldman Sachs. Goldman Sachs comes in and starts to break down with the flash crash, right before the flash crash, and probably was a signal for the flash crash. If you look at the chart when they had the alleged SEC investigation of them, there had already been a death cross, and the markets were closing, and it looked as if we were going to get a golden cross, or the 50-day crossing back over the 200-day. It didn't happen. It failed. It rolled over. The major downtrend has been established. 129 is your intermediate support. I don't think that holds up through the election. I think the action in Goldman Sachs on Friday was a very, very devastating indicator for the future. As that breaks down, the markets will break down. On the 3-year chart, I did 2 separate series from before and after the death crosses. In the 2007 area, you see the death cross, you see lower highs, and then the cratering down to its low of 46. In the current era, right before the investigation and the announced penalties from the SEC, alleged investigation, I should say, 192 was the peak. We've had a series of lower highs, lower lows, bodes very poorly for Goldman Sachs and in general in the investment banking arena as a whole. The GSEs are also not doing well. By GSEs, I'm referring to Citigroup, AIG, and Bank of America. But let's take the big one, Bank of America, for example. Look at Bank of America. You had a death cross at the end of June, and ever since then, Bank of America for almost 60 days now has been trading at under the 50-day moving average by a substantial margin. The 50 and 200-day moving averages are in a declining pattern, and the market price for the last 3 years has been in a declining pattern. What does this mean? Well, number one, it means if you were a Merrill Lynch investor, you got bailed out. Number two, if you're a Bank of America investor and you bought Countrywide and I think it was SunWest or something like it was one of those horrible companies during the mortgage absorption boom of 2007, 2008. It didn't get any better. Look at the deterioration of the stock on the 3-year chart up on your screens now. This was a $45 to $50 stock. It has done nothing but crater since. We've had a recent death cross, going back to the daily real quick, back in the 1625 to 1650 area. It's reflected on the current chart for the 3-year. We're breaking down severely. My target on this, only to give you some hint as to the stress in the economy, is between $4 and $6. And that could be an optimistic forecast, because if on January 1st everyone realizes that the FASB rules come into effect and they have to mark their garbage to market, this sucker could break right back down to brand new lows. You just don't know. Morgan Stanley is just another example. I put up a 3-year chart of Morgan Stanley to show you. Again, like the long-term chart of Bank of America and Goldman Sachs, it's a stock in total deterioration. We've had a death cross recently. I honestly think that there's a possibility this could have a stock price between $8 and $13, which to the people who are investing in that, it's going to be a huge shock. It can't happen here. It's happening here. And that is why you have to pay attention to the big stocks. Ignore all the garbage in the markets and ignore bubble vision. One of the stocks that's countering that trend, it seems, is J.P. Morgan. Look at the year-to-date on J.P. Morgan. You've had the death cross. You've had about a 3-week period, about 2 weeks now, going on 3, below the 50-day moving average. You had a substantial period from the flash crash until July below the 50-day moving average. Only for a short period of time in July and August did it trade above the 50 and below the 200 with a brief peak above it. It's not going to hold. I think we're going to see another rollover. Unfortunately for people who think that the 3-year chart looks so great, if you take this out over a decade, JP Morgan's not that pretty of a stock. We should see a breakdown now that we've had the death cross of lower highs and lower lows, and that is a $19 to $22 stock, which when you see it hit that range, you're going to know that the entire market complex is heading towards its intermediate bottom. I think we're going to trace out a pattern similar of 2007, 2008, 2009. It's going to be one of those slow, grinding bear markets where it beats the living hell out of everybody who participates or tries to bet against it. The regional banks, though, are where I think the real drama is next. Look at this chart for Regions Financial. We had a death cross back in 2007. We didn't recover until September of last year with a golden cross. We started to creep higher, and then realization came in that things are not that good in the commercial real estate market, nor the residential mortgage-backed securities market. If you look at the move right now, we have an impending death cross probably in the low sixes. That's going to be all she wrote for the regionals. I just pulled Regions Financial up because I'm familiar with them in Florida, and a lot of the real estate they're holding, they're the proverbial bag holders. They've acquired some banks, some of them good, some of them bad. But what's worse about this, a lot of the real estate they're holding is just not going to turn in states like Florida, Georgia, or the Carolinas anytime soon. So with the economy as a whole, that means things must be worse than they're telling us. Yes, look at the durable goods chart. Sorry about that. The durable goods orders from 2009 through 2010. We went from a negative in August 2009. We had a couple of very good months, and now we're essentially flat when you average it out for the year. We had one good month in April when everyone thought, we're in full-blown recovery mode and everything's going to be wonderful. Then declines, and then, of course, this month's deceiving up 0.3%, but when you start subtracting transports and defense, not the best chart in the world, and also an indication that the economy is still deteriorating. Housing is the key to the recovery, and the housing starts are in horrid condition. If you look at the line that I've drawn in this chart, we're below historical lows for previous recessions in the late 60s, the mid 70s, the 80 through 82 recession period, the early 1990, 91, 92 S&L crash period, and the current recession, which even though they've ended on the Fed charts, has not been declared over by the NBER. These starts are at such historic lows. Ike was still president when we started tracking this, and Ike had more housing starts than we do now, and we have half the population, or even less, I should say, back then than we do now. You might want to start paying attention to this because the permits are no better. Historic lows, below prior recessions, no improvement, nothing to indicate that this is going to be a sustainable quote-unquote recovery this summer, as has been proclaimed by our leader. New home sales, a total disaster. You break it down by price, you break it down by region. You've had some states and cities looking good, but new home sales are not going to clear the inventory out, and in fact the number of months of inventory have expanded as a result. So what does this mean for corporate profits? Corporate profits are the mother's milk. We've heard Larry Kudlow and the Bubble Vision crew crowing about this for ages. Well, the rate has declined from 50.4 to 37.7% year over year. It was up just 0.6% though on an annualized basis. That's not going to get her done. That's not going to keep the PE ratios of the markets where they are now as sustainable. And we've only had a $2 billion increase in net profits, after-tax profits, quarter over quarter. That's nothing dramatic, especially since most of the profits were attained by cutting people, by getting rid of overhead. What do I mean by getting rid of overhead? Let's go to this TED chart from the Bureau of Labor Statistics. We've started to see an increase in mass layoffs again. Look at manufacturing. Look at government. It's creeping up, but not nearly as bad as 2009. But in transportation and warehousing, higher than last year. Retail trade creeping up. Construction still too high. Arts, entertainment, recreation, who cares? Finance and insurance, again, who cares? It's not as severe in some areas. Healthcare, social assistance, it's increasing. I think what we're going to see is a massive spike in the government layoffs in the months ahead. That's going to be bad. And when you look at the unemployment by states, your large states are still leading the way. There's your weekly review. It's short, it's concise, it's to the point, and yes, our fearless leader who says, yes, we can, well, I say, no, you're not, no, you haven't, and yes, you can't. You're lying to people. That is the scary part about it. America, we cannot afford the mistakes that are being made here. So I hope and I pray that all of you are paying attention. Tune in to the Voice of Galt, Monday through Friday, 6 p.m. to 8 p.m. at www.thewatchmen.fm. This is John Galt speaking. For all of you, until next week, this has been your weekly Deathburger Market Report.